President-elect Donald Trump has announced a sweeping plan to impose tariffs on America's biggest trading partners, Canada, Mexico, and China, with a 25% tariff on goods from Canada and Mexico and an additional 10% tariff on all imports from China. These measures could disrupt global trade and deeply impact the US economy. But what exactly is the plan and how will it play out? Let's dive into this week's episode of 5 Things to Know. Trump's tariffs are his response to 3 big challenges: migration, drugs, and trade imbalances. Here is how they connect. Starting with migration. Illegal crossings at the US-Canada border have risen dramatically, from 2,000 arrests in 2022 to over 23,000 in 2024. Similarly, in fiscal year 2021, the US Border Patrol reported that over 1.7 million apprehensions at the southwest borders were made, marking the highest annual total on record at that time. By fiscal year 2023, crossing had risen to 2.8 million. Trump blames lax border policies in both Canada and Mexico for this surge. Drugs. Fentanyl overdoses claimed over 70,000 lives in the US last year, with the Drug Enforcement Administration identifying China as the primary source of fentanyl precursors. Trump wants to penalize China with a 10% tariff, accusing them of failing to stop the flow of illegal drugs. Even though China has imposed stricter regulation in 2019, the fentanyl trade has shifted to Mexico, where these chemicals are turned into finished drugs. This adds to the US-Mexico trade tensions. The third issue is the trade imbalances. According to the US Census Bureau, in 2023, US exports to China were $147.8 billion. Meanwhile, US imports from China in 2023 was $426.9 billion, which led to a trade deficit of around $279.1 billion. Similarly, Census Bureau data suggests that in 2023, US experienced a goods trade deficit of about $94.7 billion with Mexico. While the trade relationship between the United States and Canada is one of the world's most significant, with substantial exchanges of goods and services, the trade balance US experienced is about $64.3 billion in 2023. Trump's tariffs aim to reduce this gap, making imports more expensive and encouraging domestic manufacturing. How are other countries responding? So let's look how China, Canada, and Mexico are gearing up to counter these tariffs. China's foreign ministry has offered cooperation on issues like fentanyl, but warned against taking their goodwill for granted. If pushed, China could cut off exports of critical goods like rare earth materials, which are used in everything from electric vehicles to smartphones. For example, rare earths are a $9 billion global market, and China controls over 80% of production. Disrupting this supply could severely impact US companies, including defense contractors and tech giants like Apple. China has also targeted specific US companies in the past. Take Skydio, an American drone maker that faced a supply chain crisis when China stopped exporting batteries in retaliation for earlier tariffs. The company struggled to meet orders, including those from the US military. Canadian Prime Minister Justin Trudeau is emphasizing dialogue, but has prepared retaliatory measures. For example, in 2018, Canada imposed tariffs on US products like yogurt and whiskey, strategically targeting Wisconsin and Kentucky, states with strong Republican support. Canada supplies 60% of the US crude oil imports and 85% of its electricity imports. Tariffs or restrictions on these resources could cause energy prices to spike in the US, especially in industries reliant to affordable power. Mexico has warned that a 25% tariff could disrupt cross-border supply chains, particularly in the automotive industry. About 88% of the pickup trucks sold in the US are made in Mexico, and a tariff would increase truck prices by $3,000 on average. Additionally, the Mexican economy minister has said that around 400,000 US jobs depend on the industries tied to Mexico, from manufacturing to agriculture. Retaliatory tariffs on goods like corn and soybeans would hurt American farmers, who already face tight margins. Which industry will be hit the hardest? Trump's tariff won't hit everyone equally. Here are the industries that will feel the brunt of these policies. Starting with automotive. Cars assembled in Mexico like the Chevrolet Silverado and Ram pickup trucks could become 10% more expensive. A 25% tariff on automotive imports could cost the US auto industry billions and potentially lead to layoffs in manufacturing hubs like Michigan and Ohio. Construction is another industry. The US imported over $15 billion worth of construction materials from Canada in 2023. Tariffs on lumber and aluminium could raise housing prices by an estimated 8%, worsening the affordability crisis in cities like New York and Los Angeles. Food and agriculture. Mexico provides 60% of the US fresh vegetables and nearly half of its fruits. Tariff would lead to price hikes on everything from avocados to strawberries, hitting American families at the checkout counter. In 2018, for example, Mexico retaliated with tariffs on pork and cheese, targeting states like Iowa and Wisconsin. If similar tariffs are imposed again, American farmers could lose key markets. In terms of energy, Canada supplies around $70 billion worth of energy to US annually, including crude oil and natural gas. Tariffs could drive up energy costs, especially in manufacturing heavy industries which are reliant on cheap fuels. Also in electronics, tariffs on Chinese goods like semiconductors and battery would increase costs for products like smartphones and electric vehicles. For instance, the average price of an EV could rise by around $1,500 due to higher battery costs. These tariffs will have mixed effects on the US economy. While they aim to protect the domestic industries, they come with significant risk: rising consumer prices. Everyday items like groceries, cars, and electronics will become more expensive. Economists estimate that average American household could face $900 in additional costs annually due to these tariffs. Inflation and layoffs. Higher costs for businesses could lead to inflation and layoffs in sectors like manufacturing and agriculture. In the auto industry alone, job losses could reach 40,000 if tariffs disrupt supply chain. During Trump's earlier trade war, while domestic steel production rose by $2.2 billion under Trump's earlier tariffs, downstream industries lost $3.5 billion due to higher material inputs. This highlights the trade-off between short-term benefits and the long-term economic challenges. Global repercussions. The impact of Trump tariffs won't stop at US border. Here is how the world is reacting. The EU could face a GDP decline of 0.1% if auto tariffs are imposed, with Germany's economy shrinking by 0.23%. Retaliatory tariffs could target American exports like motorcycle, bourbon, and iPhones. China may accelerate its relocation of supply chains to countries like Vietnam and Malaysia to bypass US tariff. Meanwhile, Japan and South Korea could face new challenges in exporting cars and electronics. India could attract businesses looking to diversify away from China, aided by its production-linked incentive schemes. However, high labor costs and regulatory hurdles may limit its potential. Supply chain diversification. In the long run, these tariffs could encourage a shift towards more decentralized trade networks, with Southeast Asia emerging as a key manufacturing hub. Trump's tariffs are ambitious, controversial, and deeply consequential. While they aim to protect American jobs and industry, they risk higher costs for consumers, strained international relationships, and economic uncertainty. So what's your take on these trade policies? Let us know in the comments, and don't forget to like, share, and subscribe for more insights on world's biggest stories.